And the markets have been on a tear in 2017, posting their best performances since 2013. Before we get to the year-end numbers, take a look at how the markets closed out the week. Taking a look at how the markets ended for the year, the Dow up over 25% in 2017. It is noteworthy that just 5 stocks, Boeing, Caterpillar, United Health, 3M, and Home Depot, accounting for over half of the Dow's rally this year. The Nasdaq closing well in the green as well for the year. It is up over 28%. The Nasdaq gaining in 11 of 12 months of the year. That is a first for the tech-heavy index. And taking a look at the S&P 500, closing up almost 20% in 2017. 9 of 11 S&P 500 sectors are higher for the year. To my markets guest for Instant Reaction, Jordan Waxman is a managing partner of HSW Advisors at Hightower. Good to see you, Jordan.
Good to see you, Lauren.
I'm reading a Friday headline in the Wall Street Journal, and it says, everything went right for the markets in 2017.
Yes.
Bold statement, bold headline. Is it true?
Everything went right unless you were long the dollar or long energy infrastructure or you were in the insurance business, right? You had 2 named hurricanes hit the United States and forest fires in Southern California, Northern California. Aside from that, yes, if you took risk this year in and out of the United States, you were rewarded.
What were the best performing sectors in your review, and the sectors that you think will do well in the new year?
So technology obviously was the best performing sector, whether you're in large cap, small cap, semiconductors, software companies, everything worked. And for good reason, right? I mean, these are companies with lots of cash, plenty of ways to grow, either by acquiring companies or investing in new technologies, and you're in the middle of a revolution in terms of technology and robotics and self-driving cars and other things.
Jordan, I get it. I really do. But as a sector, the tech sector is up almost 40% in 2017. Does that still go that much higher?
Yeah, so I don't know if you're going to get a 40% run in 2018, nor do I think you're going to get a 20% run in the overall stock market next year. But double digits, I think, is in the cards. You still have pretty good earnings growth and fueled by an additional tax cut for corporations in the United States. Other countries are following suit by lowering their corporate tax rates. Interest rates are still low, so monetary policy is accommodative, and companies are growing.
Let's move into, you brought up tax policy. We'll start to see the impact of that in 2018. I can think of deregulation, potential infrastructure spending. We might see a plan emerge in the first couple of weeks of the year. Are these all positives for the market?
Interestingly, if you're an accountant, you've seen it already. I mean, my accountant is working through the weekend. So,
they're all complaining.
So if he's watching now, I'm surprised.
Business is good.
Business
for the
is
CPAs
good for the
in your
CPAs.
life.
Yep, and the attorneys. So you'll start to see the impact of that. I think you've had some announcements on Friday of corporations that are going to see some tax repatriation of capital that's going to cost them a one-time earnings charge. So that's going to start filtering through the market. But I think the market will overlook the charges and look through to what it means to the bottom line. The most impact is going to be felt in small and medium-sized companies that pay higher tax rates to begin with. You know, General Electric, which is going through its own issues.
Dog of the Dow this year
course.
and last, too.
And next year, I think you'll hear talk of it getting busted up into different parts. That's why I think value outperforms growth next year. The companies that have been underperforming, the low PE companies that will benefit from lower taxes and that have assets that the companies that are repatriating capital, they'll be looking to make acquisitions.
Right.
So small cap companies as well will benefit.
There's a lot of talk that the tax code will enrich companies and their shareholders and not necessarily go to the employees with bigger, fatter paychecks, which is what so many of us want to see. But this is the flip side. If we do see wage growth and we have this Fed starting to hike interest rates, maybe arguably too aggressively, are you in a situation where that could be the catalyst? Inflation that takes down the markets in 2018?
I think there are 3 potential takedowns of the market: inflation, geopolitical risk, and earnings misses. Inflation is my least, I think, the least problematic, because in the United States, most of inflation comes from wages and from home prices.
Well, home prices could come down.
I think home prices do come down, especially in the tri-state area in California.
Right.
That's, I mean, I think not being able to deduct all of your property taxes, a higher mortgage rate, those are going to hurt. State and local tax exemptions going away, that's going to hurt. The geopolitical risk is always there.
Yeah.
And so the third, I think, is more likely, which is you get an earnings miss. Now that the market's trading at 18 times forward earnings, there's a high expectation that there are going to be some beats out there. Yeah. And if you see a couple of bellwether companies miss on the top line or the bottom line, that might hurt the market.
Well, FactSet is saying 12% earnings growth for 2018. Not bad.
Not bad. So 12% earnings growth, and the best companies will be growing 15 to 20%. You have to buy that asset.
But you're optimistic overall for the new year?
I certainly am. And again, we're tilted more towards small cap companies and internationally, but yes, absolutely.
Yeah, most people are. It's looking good. Jordan Waxman, thank you so much for your perspective.